Hello everybody and welcome back. Well, it's a wild 24 hours here on the first day of trading for the week ahead, and we know that markets are all about manipulation right now. What happened on Friday through the options expiration and the movement in the last hour, what happened now at the close of the Monday session with the gap that now takes us back down to this level, and the potential of a pattern such as the inverse head and shoulders setting up to fill that gap on the left-hand side. Let's talk about markets around the world right now. There's a lot to discuss. See you soon. Well, welcome back everybody to the channel where we talk about stocks, commodities, and cryptos daily. This is our daily show for the markets close 23rd of May 2022, and we'll begin by talking about extreme fear and greed. And obviously, we are in extreme fear right now. Some people will be sensing the opportunity. We're on the brink of a technical bear market. And as we know, and as we talked about on the weekend video, rallies began to happen throughout the session. It was a nice green day here. We were doing a live stream into the open. You're welcome to go watch that and check it out. And we thought about a few critical zones. One of those was the gap fill on the SP 500. We'll look at that in just a second. But it was broad, and that's good because it meant that Wall Street was buying pretty much every one of the sectors and all indices were improving. So we had a rally in the morning followed by a dump to fill the gap on some of the markets such as the SP 500 and of course the Nasdaq, and then we saw a rally that pretty much ensued till the end of the day. It held up and it held firm, and we'll look at that later when we check out the indices. Was every sector coming with it? Well, they were. In general, almost every sector was coming up. Metals did really well. Banks did incredibly well, 3.25% up. We looked at that in the session and said that might be one of the stronger ones. It ended up holding throughout the day. And then we had also energy and technology, agriculture, all of these sectors much better than they have been. So does it mean that the market is cheap right now? Well, a lot of you are going to say, this is a market, it's going down. And you could be completely correct. I mean, if we look at the Buffett indicator, value versus historical trend since the 1990s, you'll notice that we're basically entering into the first fairly valued area for the markets, one standard deviation away. We've only just come back to this and we've knocked off 20 or 30% on Nasdaq and 20% on SPY. So really, we're back in an area that has been historically fairly strong for a while throughout that last kind of big pill up in the bull markets. Will we move here? Well, it makes sense that this is an area for a bounce to potentially occur, but it doesn't mean that by historical values, the market is cheap. Another thing that I think is really interesting is just seeing how many people have moved to passive investing. Now, passive investing is obviously a way that a lot of people like to invest, S&P 500, Nasdaq and everything. Check out this rise of the ETF. This is huge. And I think this will have ramifications in the market over the next decade as more people go to passive investment investing. And this should eventually outstrip active. And what that will mean is certain dynamics in the markets, I believe, will change. What stats made us think that maybe we've hit a bottom? Well, one of them is, of course, the unusual company of the S&P 500 joining 7 weeks down. This is the first time I've ever seen it in my trading and investing career. I started back in 2009, and guess what? This is the first time I've ever seen it. 2001, we had 8. 1980, we had 7. 1970, we had 8. And then 1953, we had 7. Each time, big drops, consecutive weeks down are very rare. And that's exactly what we've seen. So are we about to bounce? We're right on around the right correct zone for it to occur. And we've seen the first inkling that that might be happening in the markets at this stage. Seasonax, also seasonality for midterm years seems about correct. That back end of May seems to be where you get that run. But that doesn't mean that we can just sit here and say, oh, well, it's all good. Because the problem with midterm years is they tend to weaken into the back end. And I've been talking to some large bond investors, the ones that manage billions of dollars, and a lot of them are calling 3,400 or even worse for the SPY by the fourth quarter or first quarter of 2023. Now, I'm not here to freak you out, but it's just interesting hearing bond traders' opinions on the market versus stock traders' opinions. At this stage, rallies seem like the most logical conclusion off the levels we'll look at soon. Sentiment, as we know, sentiment indicators can help us to get an idea of generally how scared people are. And in general, people are very scared. 50% of people voted bearish in the next 6 months. 23.6% said they had no idea, and 26% started going bullish switch in the last week. This is the survey taken last Thursday. So basically at this stage, it might have switched a little bit, but generally I'd say it's fairly normal like that. Let's get into the technical analysis now. We'll talk about the VIX straight away, the fear index as many people call it. Another day of down for the VIX. Again, theoretically a good thing here that the VIX has dropped. It means a bit of volatility's come out and the potential here for a rally to occur becomes a little bit higher. So VIX traders, if you've ever been looking at the VIX, 35 is a huge level to always watch. And obviously 25, which is here, big level where VIX traders might expect a spike, and 20. They're the main kind of things. The 5 increments on the VIX are usually the most important zones to be watching from a support resistance standpoint. PCC, put call ratios, have they dropped or remained pretty high? Still generally a little bit more puts being entered into the system than calls, and that's been consistent now for 2 weeks. And it's why options expiration Fridays have become so much manipulation. If you don't believe it, just look at when we said 390 was a big call last week and the market went all the way down, hit that bottom 380, and then the last hour ramped all the way back up to 390 to close right around there. Options manipulation is real, and PCC shows here still a lot of puts being entered in the system, so still a lot of fear going into these markets, which makes sense where we're at. Let's look at the US 10-year, another day of slightly up here. We've got a bit of a trend line occurring here, and as we said when we were over here, we kind of felt that the 10-year could be starting to actually drop off, and I'd like to see it maybe go a little bit higher, but then start to drop. New trough would be very nice here on the US 10-year. Get that back down to where I hope it goes, which is a 2.5 to 2.4. And to really bring some kind of resemblance, remember, we know demand's lowering. I mean, there's no way that everybody out there is feeling as rich as they did at the start of the year. And that's going to lower demand across most assets. And the individual kind of trade that goes with 10-year is generally going to be TLT. That's the US Treasury year bonds. Now, most people aren't interested in bonds and they say, oh, bonds suck, bonds this, that. But you've got to remember, bonds do move the markets. It's a huge part of the investment triangle between cash, bonds, and stocks in the markets. Here we have the first rundown. Here we have the second rundown. I've already done this on previous videos, so I'll skip over it. You can see the similar moves. And the only reason I'm ignoring this is because this is maximum pain. That's a trap where it looks like it's buying up. It instantly reverses. So we can, of course, ignore that component in our TA. Now, you'll notice that this is kind of predicting this idea that Treasury should rise. Now, if Treasuries rise, that will also mean that the US 10-year should come down. They're about 0.7 correlated with each other. So we generally see them going very close together. US 10-year comes down, TLT theoretically should go up. Let's move over to the US dollar, another thing that we've been looking at. So we talked about this in the previous session, and we suspect that the US dollar should rise. Maybe around that 103 could be an interesting area to see the bears come back in. And we've just busted off this seriously big trough on the higher time frame. So if you go to a daily, if you go to a 4-hour, any of those time frames, it'll look like this. New peak. So this is the peak. This is a higher peak. Now we've got a lower trough. So that is, we've formed underneath here. That's kind of breaking the sequence of events. So the first on the time in a while, the daily is now technically down for the dollar index. And that means that rallies, such as a rally around 103, which would hit a 20 moving average as well, this red line here, could be a point where we expect sell-off to occur. And again, if the DXY, that is the US dollar, is becoming less desired, often that will mean that risk on assets across the world could be in demand. It's not a guarantee that that happens, but it's certainly one of those things. It also has long-term ramifications for things like gold as well, which we've been very bullish on over the last couple of days. And we got bullish once it broke through this trend line and hit our demand. So we've go back to the other videos, watch the gold analysis. I think it's been quite good. And congrats to anyone that was in this. We obviously made a maximum pain kind of bottom. We breached through that trend. We broke high, which got through the downward kind of trend line here. And we came back and we found a little double bottom. So here's a little double bottom that occurred here. And there is the spring. And we get that massive move off the spring. If you know how to find springs, well, it makes trading a lot easier. But spring's certainly there. Now, as this stands, I thought it would probably stop around 1853, so around in this area here. It went a little bit higher to this next level of supply, and now it's dumped back down. I wouldn't be surprised at all to see gold decline, but of course this is going to be very heavily synergized with that DXY. If the DXY comes back to 103, what do we expect gold to do? We expect it to decline versus the US dollar and potentially come back into this zone here, which is going to be around that 1835 kind of area. Could be an interesting area for people to look at, bring their own systems into, and then of course look for their triggers, etc. if that's what they're doing. So yeah, gold improving. US oil definitely on still the decline. I think that this is a difficult trade at this stage, other than maybe having a longer term concept of short. I've kind of said this about both oil at this level and of course gas. Now gas, they call the Widowmaker, and unfortunately it's called the Widowmaker because gas can do really random things. So this is exactly the area that I was talking about, potential weakness. Now if you take gas, why they call it the Widowmaker is because it can do sporadic things. That is, gas is crazy. It will go to new highs and it will blow off those new highs very fast. If you're taking gas trades, usually the better way to do it is not to do it with a CFD, that is a contract for difference, or with some kind of margined asset that you don't have risk management on. So why that is because when it hits into these zones, it can easily bust stops off and then instantly reverse and then come all the way back down. You'd be surprised. Go back and look at the left-hand side of natural gas, and it has a large history of being a crazy trade. So this is not one that if you take it the wrong way, you can get really punished. And I just want to put a warning out there for people because they don't call it the Widowmaker for no reason. It's pretty deadly trade out there with natural gas. Tesla did rally, however, it was pretty lackluster, 1.66%, very weak here on stocks. I wasn't very impressed by its move. And the other stocks like Apple and stuff just had way better rebounds. I think Tesla's still struggling with sentiment here. Each rally in the market recently has been less than the other one. And I still think that things like taking out these previous swings, that is taking out at least one of these swings, is the first sign that Tesla is actually recovering. And at this stage down here, it's just more of a guess than anything else, or maybe someone's got high conviction with their Tesla position. There was decent volume here, but really we need to bust this, pull back down, ideally somewhere like that range, and then rally through. And that's what I'd be looking for in a stock like this. Apple conversely did a very nice close. So it broke through these down days, and that's the first green day we've seen in a little while. Nice movement here from Apple, strong movement from the bullish hammer. I'm sure a few people were day trading this last component here, or even looking towards the bull side on Apple. And yeah, it did a very good job. This came back fairly strongly. If we look at it on a weekly chart, you can see that it just kind of holding that level as best it could throughout the last week. And again, a lot of sell-off here on Apple. Uncharacteristic amounts of sell-off. 1, 2, 3, 4. I guess you could kind of almost call it 5, 6, 7, similar to the market. Is it due for a bounce? Well, it probably wants to at least try to come back and do some mean reversion. So things like the daily 20 could be worthwhile putting on your chart and checking that out. XLV, one of the sectors that I think is pretty interesting right now, the healthcare sector, theoretically has really good Julys, the healthcare sector, and it seems to be getting ready for a potential June-July kind of rotation. Maybe it's based, and it's certainly holding up a lot better than the rest of the market. Remember, the rest of the market's been making new lows, and healthcare's dealing with that resistance. So an interesting sector. Maybe you can have that on your charts and check it out a little bit more. Let's move over to the DAX. Now, a lot of people are looking at this and they're saying, is DAX ready for a breakout? Look at this level, this 14,250 zone. Big area for the DAX. A lot of fighting. Lightning bolts of going off everywhere, changes of trend are occurring, and for a lot of people, they'll also see this as an inverse head and shoulders. There's a lot to like about a break of this level, and I think a lot of things really fall on Jerome Powell's speech and the meeting minutes this week to get us through these zones if we are going to rally. You can see the DAX is waiting for more information, and that's why it's sitting around this area. It's just hovering, getting ready. Check it out on the daily, very similar. Looks pretty nice, especially the last couple of days. We've seen fairly strong, little hammer kind of candle here. We've got the doji indecision. Do we make a decision and actually start to ramp? Hopefully so. And things are still looking okay here on the DAX. You can see the real analysis taken from the daily, why we like that zone, and why, of course, we like this area. The Dow. Now, the Dow's been pretty strong, actually looking a lot better. It bought fairly heavily in the previous session. So we had over here holding that demand zone. Didn't quite get the gap close here on the Dow. It was just too aggressive and it moved up. And now the potential here is the next 24 hours. Will the Dow start to suffer and come back down to test this 31.6 to possibly even 31.526? I really like that zone in there for the Dow. It's been pretty strong. It's changed trend, at least on the first time frame. So you can see here the trough, the peak, the lower trough, the breach. That changes our first time frame trend, and it gives us the ability for potentially the Dow to come back and then find rally points. But I think the IWM, Nasdaq, and SP 500 show us the most about these markets. So let's go over here to the IWM. The IWM still holding really nice. That is the Russell 2000, the smaller caps. As we know, it led over here. So what that means is that if we think about the market falling in January, it fell on the 24th. The rest of the market rallied while IWM failed into the 28th. Yet when the rest of the market was doing poorly, what we saw it rally back up and find that resistance and then start to hover. So sometimes IWM can lead. And what it did here was it actually formed the base on the 12th of May. That's before the rest of the market crashed through. The reason? It hit a monster level. 2018, 2020, huge level for investors. Big volume suddenly came out. You'll notice that volume spike. What do you think that is? Probably a little bit of sneaky Wall Street having a go at this level, yeah? Big volume equals Wall Street being nasty. Big volume, Wall Street being nasty. You know, volume's one of your best friends in this case. When you get that capitulation, that maximum fear, often that's when Wall Street say, ooh, value town, let's get into it. It follows the same line of thought that we had in TLT. Pull down, movement up, movement up. Now again, why do I ignore this? The false rally. So there's that false rally. We can ignore that candle. We're looking at this type of range equals this type of range. And again, it's why we think there could be a little bit of a rally coming into these markets. Hopefully it does. And I'm sorry for bears. I know a lot of you want to see, more negativity. Hey, you can have the negativity if you manage to bust new lows. That would be pretty scary for a lot of people. And I think at that point, you're seriously talking. So let's talk about where it all began today in the video. Nasdaq. So the potential here is for an inverse head and shoulders. At the time of this recording, it's 11,870. So 11,870 brings you back down to around this level. You'll notice a fairly heavy support on the left-hand side. So could we be looking at left shoulder, head, right shoulder, and guess what? A nice gap between there and here. So what about if we tried filling the gap? Where are the sellers going to be? Sellers are going to try to sell this level. Where are the buyers going to be? You would think around here, trying to buy up this level, or even down here at 11.8, trying to say, I support this, I support price at these levels, let's go. Once we breach through there, we've actually finally changed trend on the Nasdaq, at least the first time frame. So first time frame, we would change trend. And where do we target? Well, I think there's a lot of inefficiencies that probably came in through this price, and specifically this gap that occurred here. So I could really see the market trying to get back up there. And think about this inverse head and shoulders. How do we take distance? Usually you take distance from the bottom to the neckline and extrapolate that out. And this is what we call proofing in the market with patterns. And you'll notice it proofs, it doesn't get closer than that yet to the top. It proofs perfectly. And that's not curve fitting, it's damn close. So this is literally the level that the market's saying, if we breach through here, we're kind of looking to rally up to this point. And that makes sense, because where are the bears going to try to sell this market back down? Well, this would be a huge level for bears to start targeting. And for anyone that says, oh, well, you're so bullish, it's just because, 7 weeks in a row down, hitting technical zones, knowing that markets like to mean revert, knowing markets are outside of Bollinger, it helps to prove that kind of concept. Again, here's the market. It's outside of the Bollinger. Look, when it goes outside the Bollinger, it likes to do a little bit of sneaky mean reversion. That is, come back to the 20 moving average. Maybe even the weekly 20 moving average. Notice where that is, 4,300. Notice where that big resistance was, 4,300. So we've got two big zones here on the SPX. We've got a nice rally. It broke a new high. So that is, it got through that 39.50 zone. It actually got above it and closed. That's significant, because it means that even though the markets look horror show right now, there's probably levels where the market is going to want to potentially buy off. And where's the market going to target? Well, you would think those last highs, similar to the Nasdaq, Of course, they are connected in many ways. So we go down to something like the 5-minute and we look at this chart and we say, okay, well, what's going on here? What's going on here? Do we have any levels that have been found? And I think this is where you go over to something like the ES minis or the futures market. You'll notice if you have a volume profile on this chart, look at this level. This 39.30 zone seems like it's got a lot. And you'll notice down here, there's a lot of wicks, there's purchasing previously, there's a lot of something going on here, a lot of orders. So around that level, you would think this is going to be maybe the potential for a small little bit of testing. Obviously, you've got the real low here at the gap fill, which occurred in the previous session. We talked about that quite a lot, that idea of trying to fill that gap. We ended up getting pretty much perfect to that, and then it rallied off that zone. So congrats to anyone that had that. And at this point here, what would I like to see? Well, firstly, I'd like to fill that gap, yeah? And then after that, if we breach, hopefully the Nasdaq's breaching at the same time, and we can make our way back to these resistances to see the bears, to see the bulls fight it out at a much more logical zone. Hopefully that does occur. For the market ahead, the options still sitting at max pain 400 for the Friday. That is 400 on the SPY. And you'll notice there's still a lot of puts floating around. They're sitting mostly at 360 this week, 370 up to 390, and 400 is pretty much perfect because you'll notice there's a little bit more puts still than calls in the current market. We'll see that as it eventuates. We'll move over to Bitcoin. Frankly, it still looks horror show. There's nothing much going on in the Bitcoin market. I just don't like it. I don't know if anyone else here likes it. It just looks like it's consolidating for the next move. I've talked a lot about 32,000 being the true resistance. I want to see it change that trend and then pull back and allow us in. So something like this. I would like it like there, ideally, you know, coming back down to this range. That's not what's happening right now. The whole crypto market is at a standstill, waiting for the US markets, I believe the Nasdaq specifically, to actually show something. They're correlated to a degree because it's risk on. This doesn't look like risk on right now. It kind of looks scary. If you haven't already, come and follow us at FX Evolution on Twitter. And please remember, there is a lot of news coming out. We said about Powell, and if you think about it, he's coming out 12:20 New York time. Fed Chair Powell speaks, horror show. Like, we don't like Fed Chair Powell because he's annoying for our trades, yeah? He's coming out, who knows what happens, I'm sure shenanigans. FOMC meeting minutes also 2 p.m. Don't forget that, Wednesday 25th of May. And then we come down, we've got the prelim GDP. Usually doesn't move markets, but at the moment anything can. And core PCE price index on Friday, 8:30 a.m. So there is a lot of news stacked. Be careful out there. And as always, when the VIX is super high, that is 25 plus, be nimble, be fast. And remember, swing traders tend to get beaten up in this market. A lot of people have resonated with that and they wonder how they get beaten up. Big VIX, that is 20 plus VIX, it's not a technical time for swing. It's a nimble and fast and really more of an investment time. So thanks so much for watching. Subscribe, smash that like button, guys. We'll see you in the next one. And also, thanks so much for getting us to 90K yesterday on the live stream. That was awesome. Really appreciate it. Bye for now.